Assalamualaikum warahmatullahi wabarakatuh. We are from student BA242. Will be presenting about art and science of corporate financial decision making on capital structure concept. Our group is consists of 4 persons including me, Amirul Afiq, and 3 other friends, which is Hafizul Hakim, Wan Arif, and also Muhammad Yazid.
In this study, we will be discussing 2 key topics related to capital structures: debt restrictions and the management of cash for future growth. The aim of this report is to enhance understanding of capital structures and prepare readers for future presentations. Capital structure is a term that refers to the way businesses, regardless of their size, manage their cash in a forward-looking manner. In the following sections, we will delve deeper into capital structure and its various components. We will cover topics such as agency cost of equity, pecking order theory, financial distress, factors that affect capital structure and capital structure decision, financial cost distress, and how to determine the optimal capital structure, including the signaling hypothesis. Hi, my name is Wan Arif. Today I'm going to present about capital structure. As you guys can see on the slideshow, what is capital structure? So basically, capital structure is the mix of debt and equity that a company uses to finance its operation and growth. Debt is money that company borrows. Short-term borrowing, long-term debt, loans and commercial papers are examples of debt. How about equity? Equity is money that is invested in company by the shareholders. So for several reasons, business finance their operation using both debt and equity. Although debt implies more risk than equity, and it can be less expensive source of finance. And although equity is more costly, it grants investor a stake in as well as a portion of its earning. So the debt to equity ratio and the long-term debt to capitalization ratio are significant ratios used to examine capital structure. Companies should carefully consider their capital structure when making decisions about how to finance their operation and growth. The goal is to find a capital structure that minimizes the company's cost of capital and maximize its value for shareholders.
Hi, my name is Hafizul Hakim bin Rosham, and I will discuss about how to determine the optimal capital structure. First of all, optimal capital structure in a company can be described as the amount of debt and equity that results in a company which having a lowest weighted average cost of capital (WACC) while increasing the market value. In order to optimize the structure, a firm can issue either more debt or equity. Since it is difficult to pinpoint the optimal capital structure, the analysts usually attempt to operate within a range of values. It also taken into account the signals of their financing decision that could be sent to the market. A company with good prospects will try to raise their capitals by using the debt rather than equity.
We move to the next part, factors that affect capital structure and capital structure decision. First of all, the cost of capital. It is crucial to consider the cost of capital while determining the appropriate capital structure through equity or debt. The cost of capital refers to the expected return a company needs to achieve on its investment to justify the expense incurred on various projects. These factors act as a safeguard, ensuring that the capital structure selected does not exceed a certain threshold in project investment. Essentially, it sets a boundary for controlling project costs. Next is size and nature of a business. Maintaining an ideal capital structure is crucial for any business, and one important financial metric that offers a precise evaluation and insight into its debt to equity ratio. An increase in debt capital may impact the equilibrium of the ideal equity structure, which could affect a company's ability to obtain financial leverage and the credibility of its stakeholder. A debt to equity ratio that is not ideal could also impact the stakeholders' investment. On the other hand, a high debt to equity ratio make it easier for the company to obtain financial leverage, which it can use for emergencies or development projects. Next is debt to equity ratio of a firm. Maintaining an ideal capital structure is crucial for any business. And one important financial metric that offers a precise evaluation and insight into it is the debt to equity ratio. An increase in debt capital may impact the equilibrium of the ideal equity structure, which could affect a company's ability to obtain financial leverage and the credibility of its stakeholder. A debt to equity ratio that is not ideal could also impact the stakeholders' investment. On the other hand, a high debt to equity ratio makes it easier for the company to obtain financial leverage, which it can use for emergencies or development projects. Next, asymmetric information and signaling. Asymmetric information is common, where company managers possess more comprehensive insight into firms' performance and future prospects compared to external parties. This creates an uneven distribution of information, leading to an increased risk of conflicting interests and higher returns demanded by the debt and equity providers. Investors know that management knows more about the company, which is factored into capital raising decisions. Companies that rely on retained earnings avoid stock financing or debt insurance. If necessary, managers prioritize funding from internally generated cash, debt and equity following the pecking order concept.
I will be discussing about financial distress. Financial distress refers to a situation where an individual or company makes it difficult to pay invoice or liabilities, especially loans to creditors. This is generally due to high fixed costs, a high percentage of liquid asset, or sensitive returns. Financial distress is often a precursor to bankruptcy and can permanently damage creditworthiness. There are multiple warning signs for companies that could indicate where they are experiencing financial distress or is about to in the near term. First of all, company will have poor profit. The break-even struggles suggest a company that cannot sustain itself by generating internal capital and must instead raise capital from the external. This is increase the business risk of the company and reduce its creditworthiness with lenders, suppliers, investors, and banks. Secondly, restricting access to funds usually leads to companies or individual failure. If the debtor takes too long to pay the debt to the company, cash flow can be severely squeezed. A company may not be able to pay its debt. The risk is especially high if the company has only one or two major customers. Then thirdly, the declining sales or sluggish sales. This indicates that a company products or services are in no demand given the existing business model. If expensive marketing campaigns do not bring growth, consumers may be dissatisfied with their offering and forced to close their business. Similarly, if a company offers a low quality products and services, consumers will start buying from competitors and eventually the company will close the door. Even though financial distress may be a nuisance for individuals and companies, there are ways to remedy this financial distress. One of the primary methods many businesses do is to check their business plan. This thought to encompass each of its operation and overall performance within the market, in addition to putting in place a target date to perform all its goals. Another consideration is where to reduce costs. This can include reducing or cutting off management incentives, and in many cases can have a costly impact on a company's bottom line. Some companies may consider restructuring their debt. Under this process, companies cannot meet their obligation, can renegotiate their debts and change their repayment terms to improve their liquidity. By restructuring, they can continue operation without any worries. Now I will be discussing the integration of tax effects and financial cost distress. The tax effect is the company making borrowing because of the valuable interest tax shield. For the financial cost, it is a cost that a company was unable to repay debt and liabilities caused by the financial distress. The company uses its own equity to pay its debt for reducing the financial distress out of control. It is a trade-off between the tax advantage of a debt and cost of financial distress. It is difficult to express this with a precise and rigorous formula. So how does it affect? Firstly, the probability of distress is low due to the present value of the minimal distress cost. Secondly, the present value of this cost also can be high with every increase in that value. It will be equal at the point of the increase in the present value of the debt shield. Thirdly, bankruptcy increases quickly from tax shield and the present value of the companies will be low.
Next, I will discuss about the agency cost of equity. It represents costs that a company faces because of the issue in the management and shareholders, since it has separation of ownership and control. When the management makes decisions that might not be in the best interest of the firm, and shareholder view as an action that not increase their value of their shares. From that, the agency cost of equity has arisen. Therefore, agency cost of equity is cost involved to keep a check on management's decision making by the shareholders. The agency cost of equity involving with direct and indirect cost. Direct cost divided by two forms. Firstly, the shareholder need to bear the cost of corporate expenditure such as purchasing luxurious and unnecessary corporate jet as a transportation that could be increasing their company's operating cost. The second type of direct agency cost is the expenses incurred when the firm is need to monitor the performance of the management actions, such as by paying the external auditors to ensure the authenticity of the company financial statement. Furthermore, indirect agency costs represent the lost opportunity. It can be seen if the shareholder wants to run any project to raise their stock value. At the end of this topic, it can be concluded that the agency costs definitely cannot be fully or completely eliminated. The incentive and monitoring technique can actually lead to agency costs because the company still needs some additional expenses.
And now, let's proceed to the pecking order theory. According to the financial theory known as the pecking order theory, business prefer to use internal money first, debt second, and equity last to finance their operation and expansion, which means a company prioritizes their sources from internal financing, to equity and consider the equity as a last result. Internal funds are used first, and when there are deeper debt is issued when it is not present. More debt and equity are issued. Then, the pecking order theory is based on the idea that companies want to minimize their cost of capital and maximize their value for shareholders. And by financing their operation and growth with internal fund first, debt second, and equity last, company can achieve this goal to minimize the company cost of capital, maximize the company value for shareholder, and also reduce the company risk of financial distress, and do not forget it maintain the company financial flexibility. However, there are also some disadvantages to the pecking order theory, which is it can limit the company growth prospect and also can lead to the agency cost as a manager may be reluctant to issue equity when it is in the best interest of shareholder. Overall, the pecking order theory is a useful framework for company to consider when deciding how to finance their operation and growth, and company should also consider other factors such as their growth prospect, credit rating, and risk to tolerance when making this decision. Next, signaling hypothesis. Signaling refers to the act of using insider information to initiate a trading position. It occurs when an insider releases crucial information about a company, triggering the buying or selling of its stock by people who do not ordinarily process the information. The exchange of the cost incident is considered a market signal to the outsider of the dividend in the literally state when a company announces an increase in its dividend payout. Financial analysts and investors read that as indicating a positive future financial outlook for their business. Generally, increase in dividend payout paid a positive outlook for the company financial, and future stock price a decrease in dividend payout may indicate estimate hardship for the company financial. Dividend in inquiry suggests that the company that pay higher dividend will be more profitable. Therefore, the company will announce its dividend payment, which means that the annual performance will be higher profit. A company that have a long history of dividend that keep increasing issue is a signaling to the market that is a management and a board of directors a positive expectation about their future profit. If company offer a higher dividend payment, means that the company performance or profit is good for that year, with most largest company increase in dividend payout are approved by the board of directors if they are satisfied that the company anticipate making a profit in the future and the cost manageable. To conclude, the signaling hypothesis represents the relation between dividend payment and the profit of the company, and also a theory that suggests that a company attachment of an increase in dividend payout is an indication of positive prospect.